There are some novice traders that think that theta is an edge because you make money as theta comes out as time passes. But that's not really true. The reality of where traders really get edge is from volatility and skew.
Hello, wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, wealth building family. Welcome to episode 14, Geekery and Skewed Truth. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community today. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get frequency bounce back, the more you grow as a trader. The second thing you can do is to get access to video extra podcast episodes and posts chronicling my covered call and cash secured put trades that I'm making in my real brokerage account by becoming a paid subscriber. And for the cost of one fancy Starbucks once a week, you'll get the extra video extras, my trade adjustments, access to our monthly Ask Me Anything session, and really a whole lot more. It's a great value. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. Today, we're tuning the frequency again. Let's crank the dial to higher frequency trading. And let's use the tools we need to take covered calls and cash secured puts to the next level. We're going to talk about the Greeks and volatility skew and edge, specifically as it works along with cash secured puts. The option Greeks are a big topic. I could write a book on it. Wait, I did. So I'm not going to cover everything you need to know about the Greeks. It's true that the more you learn, the more you earn when it comes to trading, though. So if you can, go back and listen to the previous episodes because the knowledge builds episode by episode. And even though the episodes start at sort of the beginning of this whole journey, if you will, it's not all basic. I like to say there's not basic, intermediate, and advanced option trading. There's the stuff you got to know to be able to make money, and that's it. So there's something in every episode for everyone. As far as the context of what we're talking about, as far as the Greeks are concerned, here are the things to know right now as we take the first couple layers off this options onion. Delta. Delta is the rate of change of the option relative to a change in the underlying stock or ETF. It's stated as a decimalized percent. So a delta of 0.42 is 42%. That means whatever amount the stock moves, the option moves by 42% of that move. Now, people always talk about, well, if the stock moves $1, the option moves by the amount of the delta. And that's true. It's just kind of like a cop-out, very simplistic way to look at it. And it's not a bad way to look at it. I mean, it's true. If the stock goes up by $1, the call goes up by, 42 cents if it has a 42 delta. And yeah, that is 42% of $1. But what if the move in the stock is 57 cents or $2.31? Well, that's why I like to point out it is a percentage. And all you have to do is multiply that dollar move, or I should say the move in dollars of the underlying stock, and multiply it times that decimalized percentage, 0.42 in this example. Now, this part here is a little bit tricky. A lot of people talk about delta and specify positive delta or negative delta, which is synonymous, by the way, with long delta or short delta with respect to the order. Personally, I just think of how it relates to bullish or bearish. I'll just say, like, the call is 42 delta, and I know if I'm long the call, I make money as the stock goes up 42% as much and lose if the stock goes down. So technically, if you own a call, you have a positive or a long delta. If you're short a call, you have a negative or short delta. And then there's puts. Ah, yes, puts. Puts are tricky for some people. It's just a sticking point for a certain percentage of people that makes it hard at first to wrap your brains around put deltas. But in an option chain, you'll usually see the put deltas displayed with a negative sign in front of them. So you might see like a negative 0.39 delta for a put. So 0.39, that's 39%. And the negative sign, that's just meant to indicate that it has an inverse profitability to the stock. So same idea here that I talked about before. In my mind, I mean, I just know puts move inversely, and I don't know, in my mind, I just sort of ignore the sign, and I know, like, if I own a put and the stock goes down, I make money. If it goes up, I lose. Though, really, we should be talking about a short put, I guess, right? This whole Wealth Building with Options podcast is about covered calls, which are short, and cash secured puts, which are short. So, let's talk in terms of being short them. So, okay. I just know that in my mind, if I'm short a put, like in a cash secured put, and the stock goes up, well, that helps me, right? It's a bullish kind of position a little bit. And when it helps me by the amount of the delta. And if the stock goes down, it hurts me by the amount of the delta. Okay? Percentage terms. Easy. So maybe the way your brain is wired makes more sense to think in terms of positive or negative signs. Or maybe it makes more sense to think in terms of long or short, right? Or maybe your brain works like mine, just thinking about it in relation to the stock or whatever. Whatever works for you, it doesn't matter. But now here is the kind of important thing. And it's something that I think will make your knowledge of the Greeks when it comes to trading covered calls and cash secured puts way easier. Because the option moves as a percentage of how much the underlying moves, we can think of it as a fractional amount of shares based on a 100 share lot. Okay, let me say that one more time. Let's think about delta as a fractional amount of shares based on a 100 share lot. So I think the easiest way to explain this is to use that low hanging fruit of the dollar move that I was talking about. So if I'm short a cash secured put with the 39 delta, so that's a positive delta, right? It would be bullish in the stock, even though it's bearish in the put. And that's why I say this gets kind of confusing for, kind of a lot of people. It is a little confusing. I'm short the put, but I have a bullish position in the underlying, right? So long delta, short put, long deltas. It can be confusing. So anyway, if I'm short a cash secured put with a 39 delta, if I sell that put, I make money as the stock goes up to an extent and lose it as it goes down, all else held constant, right? So if I have that short put with a 39 delta and the stock goes up $1, I make 39% of $1 or $39. right? So if you think about it, that's like owning 39 shares. Thanks, Wilhelm. That's Wilhelm, by the way. He helps me out sometimes when we need, a little scream here or there. But yeah, so it's like owning 39 shares if you think about it, right? So that brings us to, well, basically to another definition of delta that's super useful to what we're doing here on the show and in our investing. Delta is the options sensitivity equivalence to the number of shares an investor would be long or short. Like, I don't know. If you're taking notes, write that down. If you're driving or running like I do when I'm typically listening to podcasts, please do not take notes. Just make a mental note. But I'm going to say it again. Delta is the option sensitivity equivalence to the number of shares an investor would be long or short. It's how much the option position acts like the stock from a pure directional standpoint. So, if I have a long or positive 39 delta, I'll profit or lose as if I was long 39 shares. If I have a position in which I'm short or negative, say 47 deltas, I'll profit or lose as if I were short 47 shares. Okay, now here is where the real magic happens. And I know I'm being a big nerd. I still get excited about this stuff after 30 years of looking at it and thinking about it. What is the delta of the underlying stock? No, not now, Wilhelm. We don't need you now. I think they're going to get this one. What is the delta of the underlying stock? Say 100 shares of the underlying stock. Well, how much does the stock act like itself? If you said 100%, ding, 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 you're correct. I mean, duh, obviously, right? And that's the thing about stock. The Greeks are easy with stock. It's 100 delta. There's no theta, no gamma, no vega, no anything else, just 100 delta. So here's what's cool. And here's what is a really key way to look at covered calls. When we have two parts of a position, like two legs, like we do with the covered call, so long 100 shares and then short one call, we simply combine the deltas of those two legs. So say we own 100 shares and sell a 24 delta call to complete a covered call. Well, that means we're long 100 deltas on the stock and short 24 deltas on the call. So net, we're long 76 deltas. And you can think of that with, the signs mathematically. You can say positive 100 deltas on the stock plus negative 24 deltas on that short call equals positive 76 deltas. You can do it that way, totally. It's easy that way. Doesn't matter how you think about it, but that's the concept. So everything you need to know about delta, that's it. I mean, I just explained it. That is literally everything you need to know about delta. So now what about theta? So when you see a theta in an option chain, and I'm going to do a video extra on this so that you can get a hands-on experience with it so that you can get it. So when you actually see it, you recognize it. But for now, or if you're not a subscriber yet, please just try and visualize this for a minute. Say you're looking at an option chain and you have your Greeks in there, right? Which you should. Probably the way it's displayed, because this is the way it's displayed by every broker that I can think of, the theta will have a negative sign in front of it. And that's because options lose value as time passes. So it's kind of like assuming that the option is from the long side, like you own it. But again, with everything we do with Wealth Building with Options podcast, we're selling options. We're selling calls as part of a covered call or puts as part of this cash secured put. So when the option loses value, the option itself makes money for us, right? Because when we're short something, we sell high and then buy low or let it expire, but usually buy low. So that negative sign is actually a benefit to us. And again, it's the same idea. You can think of it in terms of a negative sign. Hey, I sell an option that's a negative times the theta, which is a negative. Two negatives times each other is a positive, right? And I say times because specifically, like if I sell one put that has a negative 0.06 theta, that means that I make 6 cents a day, right? So think of one contract that I'm selling. So -1 times negative 0.06. But if I sell two puts, that's -2 times negative 0.06. So that's 12 cents a day. So like all this stuff is I would say, I mean, I guess I can say additive, right? Two contracts is just one contract plus one contract, additive or multiply. Yeah. How mathematically, however you want to think about it, doesn't matter. Okay. But you just basically multiply the theta times the number of contracts. So that's really kind of it with theta. It's pretty simple. I mean, the only one thing that's kind of a little confusing is that, like, when I sell a call, I have negative delta. When I sell a put, I have positive delta. But that's the only Greek that it matters if it's calls or puts. Everything else is just if it's an option. So with theta, if I sell a call, theta benefits me. If I sell a put, theta benefits me, right? It's positive profit potential for me. All right. Next, let's talk about edge. There are some novice traders that think that theta is an edge because you make money as theta comes out, as time passes. But that's not really true. The advantage is directly and equally offset by the negative gamma that you get from being short options. Now, I don't want to get super hung up on gamma, but what it is it's how much your delta changes. And really, just like super big picture, what negative gamma means is it's basically the idea that you have limited profit potential and much bigger loss potential on the options component itself. But gamma is sort of a tale for another day. The reality of where traders really get edge is from volatility and skew. Let's talk about this by revisiting the options is like insurance idea, which we talked about some in the prologue episode and also episode 5, Better Tools. And I definitely encourage you to go back and check those out. I encourage you to start from the beginning. When I've taught classes on options or held training webinars with my option trader education company, Market Taker Mentoring, or with any organization, I've often used the insurance analogy. And I used to make the joke that I like losing money on my life insurance, right? You know, but after thinking about it, I don't think I do lose money on my life insurance. I think I actually get what I paid for. Because what is insurance? Really, it's peace of mind, right? You have the policy, or, you know, a put, if we're talking about hedging with options, and in that case, a long put. And so because you have that protection, You can sleep at night. You know what your risk is, and you don't have to worry. Whether you cash in on the policy or exercise your put, that's a later decision. You already have the asset, right? It's like if you buy a car, you may or may not take a fabulous road trip. If you want to, you can, but you own the car. In this context, the car is freedom, really. In this context, insurance or a put that you would own as a hedge, insurance is peace of mind. You own that. Insurance policy premiums are calculated by people called actuaries. In a nutshell, they analyze a big sample of drivers in the same demographic and geographical area to determine what the premium should be. They forecast how many accidents are statistically likely to happen, multiply that by the expected average cost of damage per accident, and divide that by the sample size. Like that, basically, that's how they figure out how much they'll pay out, or i.e. lose, on each policy, right? So basically, they set the premium to be charged to be a figure that's a little bit more than that, a little bit more than what they expect to lose overall, right? So like think of what they expect to pay out as the loss and what they take in as the revenue, right? In between is the profit. That's the insurance company's profit. That's it. I pay it. You pay it. We're glad to pay a little something extra for peace of mind, right? Now, of course, we're price sensitive about insurance, just like we are about anything else. If the premium gets too pricey, one might deem it not worth it and choose not to buy the policy. But a little extra, it's fair. You're getting what you pay for, peace of mind. Well, that's the risk premium in options. People pay it. Thus, they must think it's fair, right? And you can make a case for it being reasonable for an option to trade at a little more than what they should be worth, right? Because they're effectively insurance policies, right? It's basically the same idea. So just like with covered calls, we talked about the risk premium for those in a previous episode. The risk premium exists for puts as well. This is the key rationale for why cash secured puts outperform. The price is higher than the value. Any one trade might win or might lose, but repeat the trade many times over and you capture the average risk premium over that period of time. You know, just like an insurance company. You know, somebody pays $1,000 for this 6-month period and then they wreck their $40,000 car. Well, sure, you know, the insurance company lost on that one, but overall they make money because they're trading it for a premium, for an edge. I'm saying trading. See, it's hard to separate the two, right? But with puts, there's an extra little nuance that actually adds like a little something extra. Puts tend to have higher implied volatility than their call counterparts based on strike proximity, right? And when I say strike proximity, that's puts. People tend to buy puts that are lower strikes than where the stock is, and they tend to sell calls at a higher strike than where the stock is. Okay. So puts can be arguably even more overpriced than calls, have an even greater risk premium than those higher strike calls. Implied volatility is the supply and demand component of an option's value, right? If there are many options listed on the same underlying stock or ETF, which there typically is, it stands to reason the implied volatilities of each of them, they could be somewhat different from one another, right? And they are. If you watch the video extra on this, you'll see the differences in implied volatilities. And it's important to actually understand that stuff. But it wouldn't make sense if they were all just like drastically different and seemingly random. Like they have a correlation. They have to. Options on the same underlying stock or ETF, they all kind of have a similar use case, I guess is the best way to say it. If a stock is trading at $150 a share, and I thought it's likely to go up a lot, say $50 over the next couple of months, I could buy the 3-month 150 strike calls, or I could buy the 3-month 155 strike calls. And it really wouldn't matter that much to my profitability. Because of this partial interchangeability, the supply and demand for them, it would logically be pretty darn similar. If we're talking about calls, the most common trades in the market for calls are either buying them outright or selling them as a covered call. That's it. I mean, those are the two biggest use cases. Investors, particularly, they love selling those higher strike calls to give the stock room to run higher on their covered calls. I mean, if a stock is going higher, the higher the strike you sell, the better. I mean, there's less fear the higher the strike call you sell. There's less fear of missing out on appreciation in the stock price. The higher the strike, the more selling tends to be observed in that strike. Now, how do I know this? Am I just making that up? No. We can look at the individual implied volatilities for each of those out of the money call options. It's lower for each successfully higher strike for most stock options and ETF options. Not all, but 95% of them, I would say. The higher the strike, the lower the implied volatility. And that's only the case because the higher the strike, the more people sell them. You're seeing demand just numerically. And as for fear, in stock trading, fear is to the downside. That is to say, when the stock goes down, that's when, people start to freak out. People love buying puts for protection when their stocks go down. In fact, do you know when people really love to buy puts? They love to buy it after stocks go down, which I know doesn't make any sense, right? Like if it's a hedge, you would want to buy before the stock goes down so the hedge makes money. But this is still one of those things that, just it's human behavior that doesn't really make a lot of sense. And by the way, you know which puts they really, really love to buy? Well, they really, really love to buy the cheap ones, the ones that are farther out of the money because they're cheaper. So the lower the put strike, the higher the implied volatility. And that's just looking at demand in play. Think of implied volatility as the relative cost of an option, all else held constant. The higher the implied volatility, the more expensive they are relatively because the more demand there is. And you tend to get like a pretty orderly, just sort of smooth line, if you will, right? Which kind of makes sense if you think about it. Like it would be weird if like the 566 calls had a 17.9 implied volatility. The next strike 567 had a 12 volatility, way lower. And then the next strike higher 568 had like 100 volatility. Like that would just be weird. It wouldn't make any sense because they do have similar use cases. It would actually create an arbitrage opportunity because it just wouldn't make sense for the demand for one thing to be so great and the demand for something very similar to be so small. Like it just wouldn't make any logical sense. By the way, I just mentioned the word arbitrage. Arbitrage means riskless profit. And it's a pretty rare thing because everybody realizes that, hey, the 567 calls, it doesn't matter if I buy them or the 568 calls. So they've got to have these similar implied volatilities. And arbitrageurs, they're the ones who hold these prices in line. If they see that, even if they see it out of whack just a little bit, they'll trade a spread or a butterfly or something like that to push those prices back into a smooth, logical line. And those smooth, logical lines, that is called the skew. And now specifically, it's called the vertical skew. And specifically, it's called the slope. But we're gonna drill down even more on this. I think we're gonna do like a whole episode on skew and really get into the fun nitty-gritty of slope and term structure and all that stuff in a future episode. But for now, that's some pretty good food for thought. And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And when you do, you will be the first to hear the next episode, episode 15. See you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.